Welcome back to the deep dive. Today we are tackling a challenge that honestly plagues nearly every global enterprise, and it's one that just drains the soul of the finance organization. I'm talking about the sheer soul-crushing burden of manual, fragmented, and just slow processes within finance shared services, or FSS.
It really is. It's like this invisible tax on global business operations.
That's a great way to put it.
We're talking about those painful month-end closes that, they should take days, but they inevitably stretch into 2, maybe even 3 weeks of just frantic spreadsheet reconciliation.
And the human error.
Oh, the relentless cost of human errors, the typos, the duplicate postings, misclassifications, and all the rework that comes from that. It just never seems to go away, no matter how much, basic automation you throw at the problem.
You've completely nailed it. We hear this phrase all the time: we need to optimize FSS, but the efforts are usually just throwing point solutions at it.
A bit of robotic process automation here, a new spreadsheet macro there.
Exactly. They're just incremental fixes on what is a fundamental and architectural fault line.
Exactly. And, that's why this deep dive is so crucial. We've been analyzing a really fascinating stack of source material today. It's a detailed strategic white paper that basically argues those incremental fixes. They're now definitively failing.
So what's the alternative?
What's needed, it argues, is a foundational and architectural shift in how finance operates on a global scale.
Okay, let's unpack this mission then. For you listening, our goal today is to define this new operating blueprint. The sources outline this really powerful 3-pillar structure.
Right.
First, you have the core mission of finance shared services itself, but it has to be anchored by a robust technology layer, which the paper calls enterprise service management, or ESM.
And then the third pillar, the one that powers it all.
The one that powers it all. Agentic artificial intelligence.
Our mission, really, is to understand how these pillars collaborate. We need to detail how these specialized collaborating AI agents can actually work together to transform FSS.
So it's a shift from, what, a reactive cost center?
Yeah, one that's just focused on cutting expenses, into a strategic asset that actually accelerates cash flow, minimizes financial risk, and delivers predictive insights in real time.
And the sources are very clear about the imperative here. This isn't some theoretical discussion anymore, is it? It's not a pilot project.
Not at all. The stakes are profoundly high.
Organizations that are still relying on spreadsheets or siloed automation or just treating their legacy systems like static data repositories, they're falling behind. And fast.
Their competitors are already getting faster closes. They have optimized working capital, much deeper visibility into liquidity. The question really isn't if AI will reshape FSS anymore.
It's how fast you can adapt your operational backbone to actually capture these benefits.
Yeah.
So before we jump into all the amazing new tech and the architectural solutions, we have to start where the pain is most acute. What are those persistent systemic problems that FSS faces? The ones that traditional, often decades-old systems like an ERP that's just a static data repository simply cannot solve at scale.
The white paper, it meticulously details several major pressure points that create this operational drag across the entire enterprise. And the first one, the most pervasive, is the overwhelming manual dependency.
Walk us through what that actually looks like in practice.
It means that mission-critical processes, and you should think high-volume activities here, like invoice processing, complex cross-border reconciliations, intercompany settlements.
Well, it's even just correcting journal entries.
Even that. They still rely heavily on human intervention. A person has to physically touch that transaction or that document multiple times.
Which translates, immediately into high operational costs and some pretty significant scalability issues.
Precisely. If your transaction volumes grow by 10%, what's the answer in a manual model? It's usually to add more headcount or pay for expensive overtime.
Which is just not sustainable.
It's economically unsustainable, especially in these global low-cost center models. And what's more, this manual process introduces recurring human errors, simple typos, misclassifying an expense, duplicate payment requests, which then triggers this whole cascade of downstream rework that just slows the entire close process down.
So the system lacks any inherent quality control at the source.
None. And that manual dependency, it keeps FSS trapped in this cycle of just reactive firefighting. But then you compound that with the sheer organizational complexity that most global firms live with.
The sources call this fragmented ecosystems.
Absolutely. Global organizations, they rarely operate on one single system, do they?
Yeah.
They often grow through decades of mergers and acquisitions or just decentralized regional decisions.
And the result is FSS operating across this patchwork of multiple disparate ERPs, different workflow tools, local finance apps. It's a mess.
It's the definition of a fragmented ecosystem. You get these disjointed workflows where a single service request, let's say setting up a new vendor, it might start in a centralized portal, then move to a regional accounting system.
Then require manual approval via email.
And then finally get recorded in the core ERP. And that bouncing ball of data, it means limited visibility for management and crucially delayed, error-prone reporting.
So finance teams are spending all this non-value-added time manually stitching data together from all these different places.
Just to create a consolidated view, which is slow, unreliable, and often out of date by the time it even reaches the decision makers.
So instead of being this strategic, integrated hub for the whole organization, the FSS team is effectively just a very expensive data reconciliation service.
And that leads you directly to the third persistent problem. Increasing compliance pressures, continuous evolving global regulatory demands, whether it's SOX, regional tax laws, privacy mandates, they're all straining these traditional reactive audit models.
Because if you rely on periodic audits, you're only uncovering issues after the fact.
Exactly. And when you discover an issue 3 months after it happened, the difficulty and the cost of fixing it just skyrocketing. This dramatically increases the risk of financial penalties, fines, reputational damage, all because of incomplete or inconsistent records.
And the manual nature of it all makes it impossible to guarantee that all the procedures were followed perfectly 100% of the time across all jurisdictions.
You can't. And that cycle of being perpetually reactive, that leads to the final and maybe the most damaging limitation.
Which is?
FSS gets trapped. It's trapped in cost containment and historical reporting, which prevents it from delivering any kind of predictive forward-looking guidance to the business. You're always looking in the rearview mirror, trying to explain what happened last quarter.
Instead of driving the strategy for next quarter.
That's the strategic ceiling. You miss crucial opportunities for savings or optimal capital allocation. And risks like customer default or supply chain disruption, they're identified way too late to prevent the financial fallout.
The sources really stress that these challenges are systemic. They're foundational constraints that no amount of human effort can overcome.
Exactly.
So, okay, we've established the mess. But this raises a really important question, especially with those fragmented systems you mentioned. If the core systems are messy, the workflows are disjointed, and the data is unreliable, can you just drop Agentic AI on top of it all and expect miracles?
The short answer from the sources is a definitive no.
Right.
That would be like putting a jet engine on a rusty bicycle.
Right.
The paper stresses that before AI can achieve any true, scalable transformation, a structural foundation has to be rigorously established.
And this is where that second pillar comes in. This is the critical, non-negotiable role of enterprise service management, or ESM.
It's the necessary scaffolding. It's what you use to clean up the operational mess and standardize the process environment.
It sounds like just getting disciplined.
It is about imposing operational rigor. ESM focuses on standardization and centralization. It standardizes every single service request, a vendor setup, an employee travel reimbursement, a GL journal posting through uniform workflows, and a single centralized service portal.
And that immediately replaces all those scattered emails, phone calls, and spreadsheets.
With structured, auditable processes, yes.
The benefit of structure is immediate, I get that, but how does this specifically enable the AI?
This standardization is the only way to enable scalable, high-quality AI adoption. ESM creates the essential foundation for intelligence. It creates uniform, centralized workflows that the AI can reliably learn from.
So it's like providing clean, consistent training data.
That's a perfect way to think about it. It also provides built-in visibility through centralized dashboards and instant audit trails. Without this structured, policy-compliant data flow, advanced AI systems can't function effectively. They'd be forced to constantly interpret thousands of unique, messy formats.
So, ESM ensures that everything the AI receives is clean, predictable, and traceable. It's the data diet that makes the ER possible.
Precisely. And this standardization has a direct, profound impact on compliance. ESM embeds policy enforcement directly into the workflows themselves.
How does that work?
Every service request, every approval is instantly logged with timestamps and associated metadata, creating an instant, built-in, audit trail. This minimizes compliance gaps because the system enforces the policy at the point of action every single time.
Instead of relying on a human to retroactively document or check compliance later on.
Exactly. It's a massive shift in mindset. You go from reactive problem solving after an error occurs to proactive service-oriented delivery where the guardrails are part of the route itself.
Okay, so with that structural foundation of ESM in place, we can move into the operational core. And here's where it gets really interesting.
Okay, that.
Because now we're talking about the cycles that define how cash flows in and out of the business. Procure to pay, P2P, and order to cash, O2C. These are the two foundational cycles that directly shape working capital, liquidity, and, ultimately the profitability of the enterprise. Let's start with P2P.
The procure to pay cycle. It has historically been a source of incredible friction. It's slowed by manual requisitions, paper invoices, mismatched documents, approval bottlenecks.
A nightmare.
A complete nightmare. But AI and ESM can transform P2P into a seamless, intelligent process that reduces days payable outstanding and ensures governance.
And it starts right at the beginning, receiving the invoice. This sounds like intelligent intake. Manual data entry here is a huge, slow bottleneck, especially in multinational organizations.
Absolutely. The system uses advanced AI-powered optical character recognition, OCR, but it's combined with deep natural language processing, NLP.
And that lets the system digitize and understand invoices the moment they arrive, regardless of format, whether it's an email attachment, a PDF, a scanned document. But, dealing with the global supply chain means invoices come in dozens of different languages and regional formats. Can standard OCR handle that?
And that's the crucial difference. The Agentic system handles multi-format, multi-language invoices without any human translation or manual template mapping. The NLP understands the intent of the document.
The intent.
It recognizes line items, tax codes, vendor details, all across global boundaries. This eliminates manual data entry completely and provides clean, structured data for the next step immediately.
And once that data is clean, the matching process is next. This used to be the three-way match nightmare, right? It often required human intervention if even a slight discrepancy existed.
Now it becomes autonomous matching and learning. The AI performs the required three-way match invoice versus purchase order versus goods receipt in real time. If there are exceptions, like mismatched quantities or a price deviation above the defined tolerance, they're instantly flagged and routed with full context.
But the real transformation, as the sources highlight, is the learning component.
Exactly. The system doesn't just flag errors. It learns from human exception resolution. Every time a human resolves a mismatch, for example, confirming a slight price deviation was pre-approved by the procurement team, that feedback is incorporated.
A continuous learning loop.
Right. And that loop improves the straight-through processing rates, meaning fewer and fewer invoices ever require human attention, which drives down operational costs and processing time.
That covers speed, but the approval process is often where the entire P2P cycle just grinds to a halt. How do we move to smart approvals and next-generation fraud detection?
Well, approvals become dynamic and policy-driven, which eliminates those sequential delays. Low-value or recurring items like utility bills or monthly software subscriptions are often auto-approved instantly based on predefined budget triggers.
So you're only escalating the high-risk invoices.
Only when necessary. Things like non-contracted spend, non-PO items, or unusual supplier activity. And even then, the AI provides full context to the right human approver for a rapid sign-off.
And what about security? In today's landscape, sophisticated fraud-like bank account redirection schemes is a massive threat. The sources detail steps that go beyond basic anomaly detection.
Yeah, the AI conducts anomaly detection at industrial scale, constantly scanning for red flags. This goes beyond simple checks and looks for structural fraud indicators.
Look at what?
Like systematic duplicate billing or invoice splitting, where a vendor breaks a single large invoice into several smaller ones just to bypass the human approval thresholds.
That's clever.
It is. And furthermore, the system performs continuous cross-validation. It checks supplier credentials against external risk databases, like global sanctions lists, for immediate risk mitigation. It also uses behavioral monitoring.
What's that?
It's constantly tracking a supplier's historical activity over time, Their typical volume, payment location, invoice structure to flag, sudden unexplained spikes in billing, or unusual changes to bank details.
So that's how it catches redirection fraud before the payment is released.
Exactly.
Finally, let's consider the supplier experience. If FSS is constantly fighting fires and payments are delayed, suppliers suffer, which damages relationships and potentially your terms.
And the implementation of AI-enabled vendor portals gives suppliers real-time visibility into the status of their invoices and scheduled payments. That transparency proactively reduces the volume of payment status inquiries hitting the FSS help desks.
By up to 50% in some cases, the sources said.
It's a huge saving in operational cost, and it strengthens supplier trust through reliable, faster resolution.
Okay, that's P2P efficiency optimized. Let's switch to the other side of the ledger. Order to cash, O2C. This cycle is absolutely critical for maximizing liquidity and assuring revenue accuracy.
O2C directly impacts liquidity, revenue recognition, and ultimately customer satisfaction. And AI introduces several transformative proactive capabilities here, starting with automated and intelligent invoicing.
Which means no more manual checks before billing a client.
Correct. As soon as the goods or services are fulfilled, the AI validates the incoming order instantly against contractual terms, pricing agreements, delivery confirmations. Invoices are generated instantly upon fulfillment.
And customized to specific customer terms.
Yes. And, critically, the AI applies the correct, complex local tax rules, VAT, GST, sales tax, and ensures compliance with any regional electronic invoicing mandates. This front-loads accuracy, which immediately minimizes common error-related disputes down the line.
Okay, now here is where the real magic happens, I think. The shift from reactive to predictive collections.
This is the core strategic shift.
Instead of finance teams chasing payments after they are overdue, the system anticipates the delay.
That's it. The system employs machine learning to analyze vast amounts of data historical payment patterns, industry default rates, macroeconomic indicators, even the complexity of the specific invoice itself, to perform deep payment behavior modeling.
Which lets it generate a real-time risk score, predicting which accounts are most likely to delay payments.
Right.
Wait, predictive collections? That sounds like science fiction to someone used to chasing overdue invoices manually. Are we really saying an AI can predict a client's payment behavior better than the seasoned AR manager who's worked with them for 5 years?
It can, but it's not replacing the AR manager's intuition. It's augmenting it with beta points that the human just can't possibly process at scale.
Okay.
So while the AR manager might know customer X has a good history, the AI knows that customer X's entire industry segment is currently under severe strain, or that customer historically disputes invoices that exceed a certain complexity threshold.
And this enables what the paper calls proactive engagement. How does that work differently than just a standard reminder email?
Well, the system triggers tailored reminders before the due dates for those identified as high risk. The communication is customized based on the risk score.
So a low-risk customer gets a gentle nudge.
A simple courtesy note. A high-risk customer might trigger a direct phone call suggestion for the human manager, complete with talking points, or even a tailored installment offer.
And all of this predictive activity feeds into highly accurate cash forecasting,
giving CFOs granular, real-time visibility into expected cash inflows, allowing them to make absolutely critical liquidity decisions.
This sounds critical for balancing risk and growth. What about managing credit risk in this accelerated, dynamic environment?
The process moves to dynamic credit risk management. The AI performs continuous, real-time risk scoring using internal history, external credit reports, aggregated industry data, and crucially, credit limits are adjusted dynamically.
Not just annually.
Exactly. They're adjusted based on evolving customer purchase and payment behavior. This ensures the business can strike the perfect balance between aggressively pursuing sales opportunities and maintaining stringent financial risk control.
I can just see the dashboards flashing red if concentration risk hits a certain threshold.
That's exactly it. FSS leaders gain real-time visibility that highlights those concentration risks, making sure the enterprise isn't overly dependent on a few high-risk customers or customers in volatile sectors.
And this focus on transparency and speed, it completely overhauls the customer experience as well, which is vital for long-term loyalty.
It does. When customers feel transparency and rapid responsiveness, loyalty improves. Self-service portals let them manage disputes, view their statement history, check payment status 24/7.
And the chat box.
Routine billing or payment queries can be handled instantly by AI-powered chatbots, freeing up the human AR team to focus only on complex strategic interactions, which fosters stronger long-term trust.
So we've covered the core cycles of cash movement. Now we need to look at the functions that maintain the organization's financial integrity: accounts payable, accounts receivable, and the general ledger. This is the operational backbone.
Right.
And the key promise of AI here is to ensure continuous accuracy and drastically accelerate the close.
Absolutely. The goal is to move these functions from just reactive record-keeping to proactive financial stewardship. Let's dive deeper into accounts payable first, specifically focusing on its role in proactive loss prevention.
We touched on fraud detection in P2P, but let's elaborate on what a sophisticated fraud prevention deep dive looks like in this autonomous AP environment.
So beyond the basic anomaly detection of unusual amounts or frequencies, AI uses sophisticated behavioral monitoring techniques. This flags truly unusual activities,
For instance,
like a sudden, massive spike in invoice volume from a vendor that doesn't correlate with the procurement team's activity, or invoices that are originating from a geographical location that's inconsistent with the supplier's master data.
and the most critical element remains the defense against bank redirection fraud, where these sophisticated external actors try to divert payments by subtly changing vendor payment details.
That's the highest risk area. The AI continuously validates bank account details against trusted external financial databases, and it tracks the full change history. If a change occurs, the system automatically elevates the risk score, regardless of who submitted the change request.
So it guards against those fraudulent schemes and reduces reliance on error-prone post-payment human reviews.
The system becomes a constant, invisible security monitor.
This proactive approach also transforms AP from a cost center into a strategic lever for cash flow optimization. How does AI actually aid the Treasury team in planning and execution?
By providing hyper-accurate, real-time outgoing cash forecasts. Predictive analytics allow Treasury teams to plan working capital with a precision they've just never had before. And the AI specifically evaluates and recommends dynamic discounting opportunities.
Explain that. How does the AI determine if paying early is actually a good idea?
It's a calculation, really. It balances the available discount rate against the organization's current cost of capital and liquidity position. So if the discount offered by the vendor for early payment, say 2% off if paid in 10 days instead of 30, exceeds the cost of financing that early payment.
The AI flags it as an optimal decision.
Exactly. It also helps categorize suppliers strategic, essential, non-critical, to help finance leaders decide which payments to accelerate for relationship benefits and which can be safely deferred based on the overall cash strategy.
That allows for true scenario simulation before making a major payment decision. That's a massive step up from a rigid, predetermined payment run.
It is.
Okay, moving to accounts receivable. The goal is always maximizing liquidity, getting cash in the door faster. How does AI transform the often frustrating process of dispute management in AR?
AI transforms dispute resolution from, reactive firefighting to proactive root cause analysis. It doesn't just resolve the current dispute, it examines historical disputes to uncover recurring systemic patterns.
Like what kind of patterns?
It's like a persistent mispricing error for a specific product line, or a flaw in the logistics process for a particular region, or just confusion over credit memos.
So it's identifying why the dispute happened in the first place, not just solving the symptom.
Exactly. New incoming disputes are automatically categorized billing error, damaged goods, service issue, and routed instantly to the correct department. Finance, operations, wherever it needs to go. Routine, low-complexity disputes can even be auto-resolved instantly using historical data and pre-approved tolerances.
And this proactive identification of risk areas, it prevents future disputes before they even happen, tightening that O2C cycle significantly.
Vitally so. And it strengthens customer trust.
Right.
The customer experience enhancement is key. Transparency, accuracy, 24/7 responsiveness from an AI handling common billing queries. That fosters stronger long-term relationships and reduces the kind of friction that leads to customer churn.
Now for the central nervous system of finance, the general ledger, the single source of financial truth. The manual effort here for reconciliations and error correction is what traditionally drags out the close. The promise is the continuous close.
That's the ultimate objective, and the agentic system makes it feasible. AI facilitates real-time matching of bank accounts, subledgers, and, most complexly, intercompany accounts continuously, 365 days a year.
So it eliminates the need for that chaotic, high-stress, month-end crunch where teams are frantically searching for differences.
If a mismatch is flagged, it's flagged immediately, not 3 weeks after the period has closed, when the data is already cold and correction is that much harder.
The GL moves from a static repository where errors pile up until month-end to a living, dynamic system of record where exceptions are corrected almost instantly.
Precisely. Which means management can rely on the ledger's integrity at any moment, not just after a painful week of reconciliation.
Intercompany transactions are notoriously complex, especially across different regulatory jurisdictions, transfer pricing agreements, multiple currencies. This is often the biggest bottleneck for global firms.
And this is where the specialized agents excel, in handling intercompany complexity. The AI automatically matches intercompany payables and receivables in real time, which eliminates the largest manual workload in the consolidation process.
And crucially,
It calculates and adjusts complex multi-currency foreign exchange differences instantly and ensures compliance with various transfer pricing rules and jurisdictional tax regulations as the transactions occur. This reduces consolidation delays dramatically and minimizes the risk of audit findings in cross-border trade.
and because of this continuous accuracy and embedded governance, the GL becomes fully geared for audit readiness. It sounds like the entire compliance model shifts.
It does. The GL shifts to a system where every transaction and every adjustment, whether it is initiated by an agent or a human, is time-stamped, digitally signed, and fully documented with the decision rationale. It's an immutable audit trail.
So the AI is constantly monitoring transactions for compliance against corporate policies, SOX, IFRS, GAAP in real time.
Which means the organization is perpetually audit-ready. It drastically reduces the massive effort traditionally spent compiling evidence for external reviews. The auditor, they essentially have access to the process of how the books were closed, not just the final outcome.
Everything we've discussed so far, intelligent intake, predictive collections, continuous matching, it's incredibly powerful automation. But the source material makes this crucial distinction. The true game-changing transformation happens when we move beyond isolated automation tools to an agentic AI framework.
Yeah.
This is the paradigm shift towards specialized agents that collaborate, adapt, and learn continuously.
That's the key architectural leap. Agentic AI moves beyond the static, brittle nature of traditional rules-based robotic process automation, or RPA, or even simple workflow engines. It's a system where autonomous, specialized agents work together within a unified framework, sharing insights to optimize overall outcomes based on dynamic goals.
Okay, so what's the fundamental difference between this agentic AI and an old-school workflow engine?
The difference really lies in three things: adaptability, collaboration, and continuous learning. An old workflow engine is static. You program the exact steps. If A, then B, then C.
And if the rules change, you have to manually recode the whole thing.
You do. Agentic AI, however, is goal-oriented and adaptive. The agents perceive their environment, they communicate their findings, and they adjust their internal execution logic to achieve a high-level outcome. For example, ensure vendor is paid within terms while optimizing liquidity.
Even if the intermediate steps change due to unforeseen circumstances.
Exactly.
Let's define the players then. Who are these specialized agents in this finance ecosystem? And what are their defined roles?
The system uses several key, narrowly defined agents. So we have the AP agent, which is dedicated to managing invoice intake, data validation, and matching documentation.
Okay.
Then there's the compliance agent, whose sole focus is screening vendors, checking transactional policy adherence, and managing risk factors. You've got the payment agent, which builds the optimal payment proposal based on negotiated terms and current liquidity models. And finally, the forecasting agent, which is constantly updating cash inflows and outflows instantly across all ledgers.
And overseeing this entire digital crew, making sure everyone is working toward the collective goal, is the supervisor agent, the true orchestration layer.
The supervisor is the central control mechanism. It's often the most complex piece of the architecture. It reads the current case state, decides which agent should act next based on the overall workflow design, and ensures the entire process completes safely, adhering to mandated financial boundaries.
And you mentioned it handles conflicts. Can you give a concrete example of how this supervisor arbitrates between agents?
Certainly. Let's say a critical vendor invoice arrives. The AP agent validates it and says payment is due in 2 days. But the payment agent reviews the current Treasury dashboard and says we have a short-term liquidity constraint, recommend paying in 5 days to maximize float.
So that's a conflict between a transactional mandate and a strategic priority.
Right. The supervisor agent resolves this by enforcing the encoded CFO priority logic. If the CFO priority is currently set to liquidity optimization, the supervisor overrides the AP request and schedules the later payment, justifying the action by citing that preset policy rule.
But if the priority was vendor relationship strengthening, it would push the payment earlier.
Exactly. It moves far beyond a static rules engine. It's making dynamic contextual decisions based on corporate strategy. It enforces safety rules and ensures the system's goals are always aligned with the highest level of corporate financial governance.
So, if they are collaborating and arbitrating, how do these agents communicate to ensure structured, auditable decision-making? I mean, it can't just be digital free-form chatter that auditors would reject.
No, they rely on typed intents. This is absolutely critical for security and traceability. Agents exchange purpose-built, highly structured communication signals, not unstructured messages.
So standardized commands like ask policy for threshold, validate bank detail, or request approval with context?
Exactly those.
Why is a typed intent better than a simple API call or a message?
Because it forces deterministic routing and it simplifies auditing immensely. When the compliance agent sends back a hold risk found intent, it is automatically routed to the necessary human exception queue, and the intent itself becomes an undeniable, time-stamped record of that decision point.
So an auditor can instantly filter the entire workflow history by these specific intents instead of reading through vast volumes of data. I find the concept of grounded decisions fascinating. If we are asking an AI to make a financial decision that could impact compliance or cash flow, it can't be guessing based on some generalized large language model. It has to cite its sources, its truth.
And this is where agentic RAG retrieval augmented generation comes in as a core component of the framework. Instead of operating on generalized knowledge, agents access and cite enterprise truth.
Meaning live data from the ERP, specific clauses from vendor contracts, the latest internal finance policies.
Goods received notes, jurisdictional tax rules, all of it.
So if an auditor asks why a $100,000 payment was scheduled on Tuesday instead of Wednesday, the agent can instantly pull up the exact line item from the vendor contract, the liquidity forecast from the treasury system, and the supervisor's policy directive that prioritized float maximization.
Precisely. RG ensures every single action is traceable, defensible, and grounded in the company's specific financial reality and documented policy. The agents attach structured citations to their output, sometimes down to the paragraph number of the relevant policy document, so auditors can reconstruct the full legal decision trail.
Which eliminates the black box problem that often plagues traditional AI systems in finance.
It does.
Let's bring this together with a robust, illustrative workflow to show the collaboration in action. Walk us through what happens when an invoice arrives for a critical, high-risk vendor.
Absolutely. So a new invoice for $250,000 arrives via email. The process starts instantly. First, the AP agent uses OCR NLP for data extraction. It pulls all the line items, validates the data quality. It then sends a check matching status intent to the ERP system, checking the invoice against the PO and the GRN.
Let's assume there's a small, pre-approved deviation on the goods receipt.
The AP agent recognizes that deviation is within tolerance, so it proceeds. It sends the request approval typed intent to the compliance agent.
Okay, so the compliance agent receives the context vendor name, amount, and the AP agent's confirmation.
The compliance agent immediately runs its protocols. It screens the vendor against the latest sanctions lists, checks the transaction against high-risk policy thresholds. It uses Agentic RAG to confirm if the vendor's country of origin requires additional due diligence. If it finds no immediate risk, it replies with approved compliance.
But what if it does find something, like a behavioral anomaly? The vendor recently tried to change their banking details.
Then the compliance agent replies with hold risk found and sends an ask policy intent to retrieve the internal banking change rules. It then suggests the next required human action, which is a mandatory callback verification.
This ensures safety. If it's approved, the supervisor takes over, considering the overarching strategy.
Correct. The supervisor agent receives the clean, policy-approved invoice. It then sends the payment details to the payment agent with the directive schedule based on optimal liquidity.
And the payment agent runs its model. Is there an early discount available? What is the current cost of capital?
And it replies with the optimized payment date. And simultaneously, the forecasting agent is triggered. It updates the cash projections instantly as soon as the invoice is approved and the payment date is confirmed, posting the cash impact to the CFO dashboard.
This framework, it delivers incredible system benefits far beyond just speed. It means operational resilience. The agents are designed to adapt to minor regulatory changes or shifts in policy without requiring the whole system to be re-engineered manually.
And proactivity is built in. Risks are flagged the moment they appear. A sanctions breach, a potential fraud attempt, not weeks later during a manual review. And critically, the continuous learning loop where human overrides are logged and fed back as training signals constantly refines the agent's decision rules.
Ensuring the system gets measurably better at spotting complex root cause patterns over time.
And ensuring decisions consider both transaction-level details and enterprise risk factors collaboratively.
The speed, the efficiency, the autonomy of agentic AI are undeniably powerful, but they bring up the absolutely crucial discussion around trust, governance, and the new risk landscape. Our audience, particularly those preparing for implementation, needs to know how to manage this transition responsibly.
This is the dual challenge that governance has to address. AI significantly reduces the risk of human error and transactional fraud. That fat finger error is minimized. But it introduces new, complex vulnerabilities that have to be actively governed.
Such as?
Things like model drift, where the accuracy of the algorithm degrades over time as business conditions change, data quality gaps that can poison the AI's decision-making, and, the catastrophic risk of algorithmic failures if the supervisor is incorrectly coded.
And traditional regulatory demands like SOX, IFRS, and GAAP still require absolute transparency and auditability, which gets complicated when a non-human agent makes a decision about recognizing revenue or scheduling a critical payment.
Precisely. And this is why effective governance isn't just a regulatory hurdle. It's a tool that uses AI to strengthen risk control. It enables real-time, continuous auditing of all transactions, automated policy enforcement embedded directly into every workflow via ESM, and predictive risk assessment that can forecast compliance gaps before they materialize.
So it fundamentally shifts FSS from merely reactive reporting to proactive risk prevention.
It does.
What are the governance essentials required for the system to be trusted by internal stakeholders, external auditors, and regulators?
The sources stress 3 core principles, and all of them must be engineered into the architecture from day one. First is transparency. All AI outputs have to be explainable and defensible, which the Arhovade framework achieves by citing source documents. Second, accountability. You need clear protocols that define exactly when humans validate, modify, or override AI actions, and who is ultimately responsible for the outcome. And third, continuous testing and validation automated routines that constantly test the models against known outcomes to ensure sustained accuracy, immediately flagging any evidence of model drift.
So that integration of governance into the system design is paramount.
That's everything.
Now let's address the human side, because the white paper is very clear that this is an engine of augmentation, not wholesale replacement. The focus is entirely on redefining the value proposition of the FSS professional.
This is the essence of the human-AI synergy.
Yeah.
Shared service professionals, their roles shift dramatically. They move away from being routine transaction processors, doing repetitive matching, data entry, basic reconciliation, to becoming high-value exception managers.
What does that mean in practical terms? What is an exception manager focused on?
They focus on the anomalies, the edge cases, and the truly high-risk transactions. This means resolving complex three-way mismatches that exceed tolerance levels, investigating sophisticated behavioral fraud flags that require human intelligence to connect disparate facts, and navigating ambiguous intercompany regulatory challenges.
So their judgment is reserved for the 5% of cases that truly demand high-level strategic thinking and interpretation, not data crunching.
Exactly. And they also move from being traditional report generators to true insight providers.
Right.
Instead of spending 80% of their time compiling static reports that are already outdated, they interpret the real-time dashboards and predictive analytics produced by the forecasting agents. Their role evolves into a financial strategist.
So they're advising leadership on risk management, running scenario simulations, interpreting why the O2C predictive model flagged a certain customer,
And proposing strategic adjustments to credit terms or payment policy. They are leveraging data to deliver proactive, forward-looking guidance.
This clearly requires a new set of required skills in the finance team. They can't just be expert accountants anymore. They need to evolve their capabilities.
They need 3 main capabilities. First, deep data literacy, the ability to interpret AI outputs, understand prediction confidence scores, and constructively challenge the system's results. Second, technology fluency, the ability to confidently work with the ESM and AI platforms, adjust parameters, and understand the logic underpinning the automation.
And the third.
And perhaps, most importantly, ethical and strategic judgment ensuring AI outcomes align with organizational values, fairness standards, and long-term strategic goals, especially in areas like dynamic credit allocation.
This necessitates specific upskilling. Are we talking about internal training programs or a complete overhaul of hiring profiles?
I think it's both. Training has to focus on shifting the mindset from reactive compliance to proactive system management. Existing staff need modules on interpreting machine learning confidence scores, understanding governance protocols, and focusing their attention on root cause analysis rather than symptom fixing.
And new hires?
New hires often need strong analytical backgrounds. They're almost acting as financial data scientists who understand the application of AI within the finance domain.
Finally, let's detail why human-in-the-loop, or HITL, is a mandated design principle, not a choice. Why is human judgment still so central for safety and accountability, even when the system is capable of autonomy?
HITL is the ultimate governance checkpoint. It ensures that autonomy is never blind and that ultimate accountability remains with a human decision-maker. Mandatory checkpoints are required for actions that carry the highest legal, financial, or reputational risk.
What are those key checkpoints the sources identify?
The big ones include high-value or high-risk payments that exceed a treasury threshold, complex three-way mismatches that are beyond the agent's predefined tolerance, and, critically, any change to vendor bank details.
That last one requires a human callback verification to a trusted, known contact to prevent sophisticated fraud.
It absolutely has to.
So the human is always the final arbiter in sensitive areas. But what happens when a human expert overrides an agent's decision? Does that break the system?
On the contrary, it's crucial for continuous learning and improvement. When a human expert overrides an agent, the supervisor agent logs the override action, attaches the human's rationale and evidence, the why they made that choice, maybe citing some unspoken external factor, and then it uses that labeled override as a training signal for the system.
So the model learns from the expert, constantly refining its rules and ensuring the system incorporates that nuanced expert judgment. It drives measurable, continuous improvement.
And better decision-making next time.
The cultural balance, then, is trusting AI for high-volume transactional processes, but strictly reserving human judgment and accountability for strategic, ethical, and high-stakes edge case decisions, ensuring FSS operates with both high efficiency and unimpeachable integrity.
What an incredible deep dive into the future of global finance. We've moved conceptually from the initial frustration of fragmented manual FSS to a vision of a fully integrated, intelligent, and resilient service core. We've seen that the required transformation arc is architectural, not incremental. It has to start with enterprise service management to standardize data and workflows. That sets the stage for the deployment of specialized agentic AI systems across every function: P2P, O2C, AP, AR, and the GL.
And the sources, through several detailed case studies, confirm that this transformation is absolutely achievable. We saw firms cutting month-end close days by half, fraud risk lowered significantly through continuous behavioral monitoring,
And the delivery of true real-time cash visibility across all operating units. FSS moves from a cost center defined by manual reactive cycles to a strategic core that is intelligent and autonomous.
That success, however, it requires more than just buying the technology, doesn't it?
No, it demands disciplined change management, mandatory co-ownership between finance and IT leaders, and a culture that embraces agility and transparency. And crucially, governance, specifically ensuring AI is transparent, explainable through ORAG, and accountable through mandatory human-in-the-loop checkpoints. That has to be engineered in the system from the very start.
Which brings us to our final provocative thought for you to consider. We've established that AI in FSS is already moving rapidly toward being predictive, anticipating customer defaults, flagging fraud risks, and forecasting cash flow dips. But the ultimate destination, the most exciting frontier, is FSS becoming truly prescriptive.
Think about what that really means. It's not just predicting that a customer will delay a payment. It's the system actively recommending the optimal strategic action before the delay even occurs.
So it could recommend adjust this specific customer's credit terms by 10%. Offer them a specific 3-month installment plan customized to their risk profile.
Or dynamically reallocate capital across business units because the predictive model shows liquidity surplus on Thursday. The future of FSS is constantly simulating multiple strategic paths, guiding the enterprise with real-time, data-driven confidence.
And when FSS achieves that prescriptive capability, it stops merely supporting the competitive advantage.
It becomes the driver of it.